Hi everyone, I'm David. Thanks for clicking and welcome to this video on how to use correctly divergences. Today I explain to you a simple, clear and profitable strategy. First, before explaining the strategy, I have to define divergence. What is a divergence? Divergence occurs when the price of an underlying asset and a technical indicator are heading in opposite directions. For example, there may be a divergence between the price and the volume, or the price and an indicator. The formation of a divergence often anticipates the trend inversion or the slowdown of a violent directional phase. In my strategy, I use commodity channel index, as it's an excellent aid in finding anomalous situations about the price trends. Moreover, using the oversold thresholds more extreme, plus or minus 150 of the commodity channel index, allows filtering many false signals. There is, on the chart, a bullish divergence when the price makes a lower low but the commodity channel index a higher low. How you can see in the picture. There is on the chart a bearish divergence when the price makes a higher high but the commodity channel index a lower high. How you can see in the picture. Now, let's see the conditions under which a divergence has to form. There are a few simple rules. However, some exceptions are granted. In a bullish divergence, the commodity channel index has to make the higher low in the oversold area below minus 150. In a bearish one, the indicator has to draw the lower high in the overbought area above 150. In a bullish divergence, the commodity channel index has not to rise above zero. In a bearish one, the indicator has not to decrease below zero. The second peak of the price has to have a Fibonacci extension of 1.13 or 1.272 or 1.414 or 1.618. Over 1.618, the pattern is cancelled. Now, let's see better every single rule. In a bullish divergence, the commodity channel index has to make the higher low in the oversold area below minus 150. In a bearish one, the indicator has to draw the lower high in the overbought area above 150. You can see that with a bullish divergence on the JD.com daily chart, with the lower height of the commodity channel index below the level of minus 150. In a bullish divergence, the commodity channel index has not to rise above zero. In a bearish one, the indicator has not to decrease below zero. As you can see, with the bullish divergence on the US dollar Swiss franc, with the commodity channel index that doesn't rise above the zero level. Then, the second peak of the price has to have a Fibonacci extension of 1.13 or 1.272 or 1.414 or 1.618. Over 1.618, the pattern is cancelled. An example you can see with the US dollar, Canadian dollar daily chart, with the second peak of the price at a 1.618 extension of Fibonacci. Now let's see all the other parameters. The trade entry is given by the breakout of a trend line, resistance for a bullish divergence, support of a bearish divergence. On the Euro New Zealand dollar daily chart, you can see drawn the trend line support, and with this long red candle we have the breakout of the trend line and the signal to short the currency pair. The stop loss should be placed about 15-20 pips or ticks below the last low in a bullish divergence or above the last high in a bearish one of the price. With a bullish divergence on Australian dollar, Canadian dollar, the stop loss should be placed, in this case, about 15-20 pips below the last low of the price. And as regards the target, I still use Fibonacci. A 1.272 extension of the movement started with the last retracement of the price gives to me the first target, where I close half position and move the stop at break-even. A 1.618 extension identifies the second and the last target. You can see the calculation on the Euro New Zealand dollar daily chart with the 1.272 Fibonacci extension as my first target and 1.618 Fibonacci extension as my final target. And finally, you can see always on the Euro New Zealand dollar daily chart a bearish divergence with all the parameters. That's the strategy. It's much simpler than it looks. You just need a little of practice. However, I have written an ebook of over 60 pages where I explain in detail every aspect of the strategy with many examples. The ebook is free and you can download it from my website. You find the link below in the description. I thank you for the time you spent watching this video. I really hope the strategy I explained today could help your trading. For everything, you can leave a comment in the section below. The only rule of my channel is good manners. And if you liked what you have seen, then subscribe to my channel by clicking on the icon below to be always updated on the next videos. I thank you again for your attention and I wait for you at the next video. Happy trading to you all!